Hello everybody, welcome to another video. Today what we're gonna continue to understand is, will Bitcoin follow its 4-year cycle, or are we going to have an extended cycle? So far we have been correct. So far we have been amazingly correct. Alright, so we are more leaning towards the 4-year cycle, a normal ending, that this time is not different, right? That's 70% is our probability for the 4-year cycle, and it's not different, and we're going down this quarter. All right, so far we're breaking important lines. So the 50-week SMA, as you can see, we stayed above it this whole cycle. You stayed above the 50-week SMA. All right. Also, if you can see here, when we broke it down, that was bear market territory. We're just going to run through it fast. Here, when you broke it down, you bear market territory, and you usually don't break it, break under it. Bitcoin doesn't break under it unless it's a bear market. Time. It's a time for the damn bear market, right? So we know this indicator has been very reliable, even though all the pi cycle and all the top indicators, whatever that people follow, have not signaled. It doesn't mean they will signal. We'll make another video for that. But because of diminishing returns and, the pi cycle indicator was amazing until you see that slowly, we will look into it. The pi cycle will not, I don't think it's gonna flash off. It's like very low chance. So please use some other indicators as well. The biggest indicator was the biggest liquidation event in crypto's history, 10 billion, $billion or something. It's crazy. That's a top signal. That's the top signal. And same as that, if we stay above it for multiple weeks, then we can confirm the bear market. What's also important is we track this fib channel, the 0.236 red line level. We have also stayed above it the whole time, except here, but the whole other time we stayed above it. So we're under it right now. That could be an early sign as well. So yeah, I think the banana zone or the bull market started from here. I think this is just an accumulation zone. That's why I do not count that personally. But you could also count it, and you would have a different probability chance of this being a good indicator or not. But nevertheless, the 50-week SMA and the 0.36 fib channel is around the same price, right? So it doesn't hurt to just assume that the bull market started here. With that said, let's jump back to where we were, where we took a snippet of the .com bubble, a price snippet, and it matches it to the T to our current bubble, not bubble, AI bubble, whatever bubble, some bubble, okay? It just matches our bull market that we had for the S&P/X, all right? What that told us is that we are heading towards a stagnation period and maybe leading to a decline, okay? As you can see, history does not repeat, but it rhymes. Here we do deviate sometimes, but we do eventually meet in the middle, and we are right now at a price level where this chart actually shows it is. We've touched on that already. I'm not gonna touch on it too much. What today I want to talk about is pulling out the US interest rate. And then at the end, we're gonna combine all the facts that we have gathered into a puzzle and complete our picture, and finally say, do we think there will be an extended cycle or not? That's the goal today, so let's get it. All right, let's put that on new price scale. Let's delete the snippet. We can get it anytime. By the way, just a rough explainer, I'll put this recession indicator as well soon, but the red lines means bear market for the stock market and the crypto market, okay? Those grayish, yellowish lines mean it was a bear market for crypto, but it was a period of stagnation, and you were better off not even investing in the, in the S&P 500 anyway, but it was not a bear market for the stock market. So, all right, so here was a bear market, here wasn't a bear market, it was just like a drawdown of, you know, like a 3-4 month, and it was around 15%. But it was basically, if we extend this price of crypto, then it was a bear market, right? Hypothetically. But here we had a bear market, stagnation, bear market, stagnation, bear market, bear market, bear market. And here we don't know. I think it will be stagnation, bear market, right? And then the real bear market might start next year. I don't know when is the bear market going to start. I don't know how. You know, nobody knows the future, right? We just make probabilities and what we think. I just feel like right now holding Bitcoin is not the correct choice, because we might go nowhere or we might go down more probabilistically than go up, right? That's the idea. It could be like the dot-com bubble big. I don't know. Maybe could be half of it. Maybe. I don't think our bear market this next year is going to be that long. That was a 3-year bear market. I don't think we're going to be that long. I think we're going to go like down for maybe 8 months something, but that's still to be determined. It's not, I didn't analyze it too much. I just want to know up, down, stay stagnant. This is all I care about. This is the theory we're trying to test. And after that, if we prove that this happened, then we can start to analyze the extent of the period and the low, and should we go short, or should we start to accumulate some Bitcoin or some other asset. You see, that's the idea. So let's come back to our very important topic of, are interest rates good for the stock market? Now, I've been screaming this on Twitter for like a 6-month to 8-month period, that dropping interest rates is not bullish. It's not bullish, okay? I hope my reaction gave you some sense now, okay? It's not bullish. It's bearish, okay? It's damn bearish. It's as bearish as you can get, all right? And we're gonna have some real data, some statistics. We're gonna get some probabilities from that, all right? So we're just gonna do first-class probabilities of yes, no, and count them and get a probability, all right? So let's start from the 2019 bear market, or whatever it is, that COVID crash. Even though it was not a bear market, dropping interest rate did cause a recession or a huge decline. Not elongated, but that's huge. And a recession. If you want to call it bear market, call it. If you don't want, don't call it. But if that's coming up next month, I don't want to be in. So I'm counting it as plus for the bears. All right? Then, as you can see here, we did drop slowly. The market went up, but then bam, right? You just cut it. That looks hella like that. Drop slowly, you know, probably hold it for longer. Like we're holding rates tight for longer. You're gonna be tired of winning, all right? While the heat is steady. And then we're starting to decline at an accelerated rate that I do not like. Next one. Okay, next one. That 2008 Supreme Mortgage, you know, collapse or bear market. Rates were high. The stock market sensed some weakness around the same time the Fed did, right? They sensed the weakness around the same time, and they very rapidly started to decrease the interest rate level. And the stock market didn't like it because there was a problem. So the Fed did not drop rates because, you know, so I saw a YouTube on video where like, oh, now the Fed is just giving medicines, vitamins for you to stay healthy. This is what the Fed is doing to the market. Sure. Here it wasn't vitamins, all right? It was, you know, chemotherapy kind of thing. I mean, the thing died. So it was bad. It was bad. If we go back again to the dot-com bubble, also the stock market sensed it first, and then the Fed was really late, all right? They sensed it after the stock market, but we still had a decline. So interest rate corresponded with a decline in the stock market. Same for the 2008, drop of interest rate corresponds to a decline in the stock market. Similarly to the 2020 COVID-19 collapse, right? Interest rate dropping coincided with a crash. Now it's to be determined. But 1 point for the bears, 2 points for the bears, 3 points for the bears, 0 for the bulls so far. All right. So a lot of people say the argument that, but the Fed has learned from its mistakes. The Fed is improved. The Fed is different now. The Fed knows what they're doing now. I mean, come on, they've been dropping interest rates for like almost a year now and nothing happened. Yeah, and I was invested this whole year because the only thing that was flashing is a few employment data and few inflation statistics and interest rates are just dropping a little bit. That was fine. I stayed invested, and there were bullish signs too, like ETF inflows and Trump, euphoria, and all these promises and everything. Sure, that's why I know. I mean, here they had interest rate dropped and the stock market went up. That's why you should be cautious, but not too cautious. If a student always gets, C or B at doing their job correctly, and I'm not saying that I would do better than the Fed, all right? If I was the Fed, I'll probably pull it down and up every day, all right? I'll be like, yo, I don't know what I'm doing, okay? But it's not my job. I don't need to do this correct. What I need to do correctly is analyze what the Fed is doing correctly, okay? The Fed gets a C for always being late, for always leading, coinciding the drop of interest rate with the collapse of the stock market. We're going to analyze more data, but so far we can say the student gets C. So why would you expect him now to get A? I mean, the Fed might cheat to get A, but I don't think that's a good thing anyway, right? Just understand the facts. This Fed is a bad student. Yeah, they're learning, but they're learning damn slowly. So they're gonna need some more time until they get B's and B plus and A's. I'll be like, okay, I trust you. I trust you to do this job well, and I will not sell when you drop interest rate. Now, I'm not saying I'm only selling because they're dropping interest rates. There's a combination of factors that are at play that all form the puzzle piece of the, they're all pieces of the puzzle that form the holistic picture. And that's what we're trying to analyze, to understand if it will be an extended cycle or a 4-year cycle. We're not just going to look at one factor, we're going to look at 10. And by the end of this video, I will combine, everything we have learned into one piece that you can make your chance, get a statistic, get a probability, and know what to do. Because that's how I knew what to do. At least if it helps me, I hope it helps you. If it doesn't, then you probably need to do your own research and more analysis. And this is not financial advice. It's all entertainment and education. Okay. So here, the Fed did drop interest rates, right? The stock market kept rallying, but they dropped it. They kept it consistent, and they were like, "Oh, yo, we made a mistake. Let's put it up a little bit." So they put it up a little bit. They kept it consistent for a while. They forgot about it, and then bam, the stock market is like, yo. The stock market just crashed. Maybe we should drop it a little bit. And they were like, oopsie daisy, they dropped it too much. And then they forgot about it a little bit. And then they were like, oh, the stock market is still going up. It's doing good. I mean, we're having a bubble. Put that thing up, man. Put that thing up. And they were like, whoop. They put it up so high. And then the market starts to crash. And they're like, ooh. Oh my god, we made a mistake. Oh my god. Drop that thing to 0. It doesn't drop to 0, but it was to 1% or something. But you can understand how they were feeling through this wave, with the market. So did the Fed do well here? I think they did at the start. They did here. Yeah, they put it up, they put it down. I think they start to mess up here. They start to put it up by accident, put it down by accident. Oh, they went too high up, and then they went way down low. So like, trust the Fed? I'm gonna trust myself. All right, so if we, okay, let's give it 1 point for the bull, 3 points for the bears. All right, so right now we literally have 3/4. So 75% chance the Fed is gonna mess up. Okay, 75% chance the Fed is gonna mess up from our data points that we have analyzed so far. Okay. If we go a little bit further to the 1990 situation, now some people are gonna say, yeah, they put it up and they put it down, the stock market did well, and then it just crashed, right? Possibly. But here the stock market didn't do well. It stagnated. That's one. Two, it's an oil shock, guys. It's not the Fed's fault, right? We don't care what happened, who caused it. We care about event leading to an event. That's it. Not COVID crash, oil crash. There's always a reason. All right. Next year is going to be a reason. We don't know what's that reason. If anything, maybe dropping interest rate is a good indicator for black swan events. If anything, because all these black swan events have have came after the drop of interest rates. Okay? Maybe it's a good indicator for both. The crash and the black swan. Who knows? Anyhow, even if the Fed did well here, they did terribly here. I mean, look at that. Look at that. They raised interest rates. The market crashes first. And then the Fed drops. So sometimes the Fed senses the weakness and drops interest rates early. Sometimes the crash happens first and then the Fed drops interest rates after. In both cases, the Fed drops interest rates. So not one situation, except maybe this situation right here. So that's one for the bulls. We're gonna count at the end, okay? 2 for the bulls now. Except that situation and that half situation, I do not see where the Fed was able to drop interest rate without causing an economic downturn and slower growth and, you know, like a stock market crash. So let's count and let's get our probability to be determined. 1 for the bears, 2 for the bears, 3 for the bears, 1 for the bulls, 3 for the bears, 4 for the bears, 2 for the bulls, 4 for the bears, right? No, 1, 2, 3, 4. Yeah, 4, 4, 4. Then 5, and if you want to count like a 6 and a 7. So total, we have 9 points. The bulls have 7 over 9. We have a 77% chance that the Fed is gonna mess up. All right, let that sink in. Let that sink in. You can add and subtract what you disagree with me on each of these scenarios, but the fact is, it is near 77% that the Fed will mess up. Okay? 77% chance that the Fed is gonna mess up. To our consequence, to our surprise, that matches our exact where's the other one? Probability for the bear market happening not within this zone, but within this zone. In an earlier video, we said somewhere between October 10th, where it happened, and probably February next year or January. The bear market will happen by 70% chance. Okay? That's what we said in an earlier video, episode 1 or 2. 2 hours, I haven't done this before, to calculate the stock market and interest rate stuff. 2 hour surprise is 77%. we discussed as well putting calculating all the bear markets here, here, and here. Took the dates, put the mean, and made a normal distribution on it. We made all the math together before, and we got those probabilities here that the stock market is gonna go down by 47, 34, 34, 47. So that's from the mean to the here, from the mean to the here, and etc. But we said 45% chance. We said 70% from here to there, February, and we're gonna take 45% chance for this, and that's why we multiplied these figures from the normal distribution to the 45% chance that this is going to happen within this area, and we get here 21% between the mean and here October 25, and another 21% chance from here to there. So in all 42% chance in this area. So that's what this means, if you're wondering. So let's combine everything together. So we said originally from our analysis of Bitcoin tops and blah 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 that 72% chance it will happen here, a little bit less there, but we just want to take a more statistical approach, right? And then we went and checked the stock market, right, and got the 77%. Let me remember, what was that? It was something like 7/9, okay, equal 0.77%, just for me to remember later. We got here 77%. That's the second piece of the puzzle. And then if we go take the path that we talked about, bars pattern, from here, right here, after coming out of that recession, actually, that makes sense that the cycle started from here. We were coming out of recession. Okay, so if we take that from here and put it here, we get that the top is near. We get a period of stagnation. And we have studied before that if the stock market stagnates, Bitcoin will not stagnate. It will go down. It will go down. I mean, it will go down. Look at that. February 2018. The crypto cycle sensed the weakness of the stock market way earlier, December 2017, like 3 months earlier. And we went down hard. And the stock market was just like at the same level for the whole period of the bear market. So either way, you would have been better off not investing in the stock market or crypto, because you could have used that money and put it somewhere else or done something with it. You wouldn't have to worry. And bear market or not, that was a period of stagnation that caused the crypto cycle to be in a bear market, and therefore it was not a good time to invest anyway. May 2015, that was a bear market for the stock market, right? But crypto sensed it way earlier, in 2013 even, like right, December 2013. And we went down for the whole period of the stock market, and then we started to go up, right? So crypto sensed the weakness of the stock market way earlier in that situation. Here, it went down just because of a weakness. Here, it went down because it sensed a bear market. That's why it was maybe earlier. Here, we went down together. Here, even if the stock market just stagnates, doesn't do anything for the next year, I think Bitcoin can go down. That's why I think it's a risky bet here as well, kind of extend. It's a risky bet to bet on Bitcoin right now. It's a very risky bet. If we take that with the interest rate, with the stock market divided by the world money supply, you get, we're in this period right now. I mean, we even had a similar crash here. Look at that. Look how similar is that. That one. We're getting to a period of stagnation here on that chart as well. If everybody's talking about the money supply, whereas here's the money supply. Stock market returns versus the money supply. That's a good measurement, better than just measuring the money supply just goes up anyway. In bear markets and bull market and stagnation, sorry, we just keep printing money. So why not compare it to an asset that's getting inflated? Comparing they're both inflation rate, right? We're comparing the inflated price of the stock market against the inflated money supply. So you're seeing a better and more complete picture of the situation. The money supply is going higher, but the stock market has went higher too. So this is my argument for you. I hope I gave you something to learn today and something to think about. and I'll see you on the next video.